Welcome to the Lending Brief podcast, brought to you by the GovNavigators and sponsored by Allocore. Allocore brings the precision and expertise of commercial banking technology to the public sector. From preventing fraud in small business loans to reimagining how Treasury processes payments, our guests share firsthand stories of innovation, challenge, and impact. Whether you're in government, financial services, or technology, this series reveals how modern lending platforms can better serve the public and protect taxpayer dollars. Welcome to the Lending Brief. So this may be the guy who knows more about federal lending than anyone else on the planet.
Yeah, I think that's true, actually.
Anthony Curcio, senior partner founder of Summit Consulting. Anthony, so delighted to talk to you and geek out on federal credit.
I am too. I could just sit and talk about federal credit all day long. I don't know if I should be embarrassed by that or not. And by the way, just for the record, in case Albert's listening, Albert founded the firm just a little bit before me. But anyway, he and I are senior partners together. It's great having him. He's an economist and I'm a finance guy. It's
Why
like
couldn't we,
peanut butter and chocolate.
Adam, why couldn't we get him?
I'm
just kidding.
We got the message.
So, thanks for the correction. So tell us about Summit and what y'all do in this landscape.
Yeah, thanks for asking. So as I explain to my clients, there's a million things that Summit doesn't do, a million things. We do a few things very, very well. And one of that, and that really revolves around what we call internally federal finance, which includes federal lending, but also selected grant programs that are associated with projects, energy, infrastructure, and industrial policy, nearshoring. CHIPS is an example. CHIPS is paired with it's a loan program and a large grant program. We're not a grant shop. If you're passing out 10,000 grants, en masse, that's not what we do. But we recently included within federal finance that grant component. But in the main, this is a federal credit shop, and that's where we go really, really deep. And strategically, we have decided that as a recruiting strategy. So we are recruiting a lot of folks that have deep backgrounds in finance, who have backgrounds in a regulatory position within the U.S. government, regulating credit programs. And so that's how we recruit. It's what we do when we're eating a ham sandwich. We talk about federal credit, so we go very deep on federal finance, which is mainly federal credit.
So, and just quickly too, tell us did you draw the short straw? Like, how did you get involved in federal credit? Like go way back. And I think it's also like, sometimes when people end up in these situations, they're like, did you wake up after like a night of heavy drinking and they're like, oh, I guess I have to do this now. Oops. Tell us your background real quick.
Okay. And I'll make it quick, but it's a little bit overlapped with Robert. So when I was in business school, I was pursuing an MBA and a master's in economics, international studies from SAIS and Georgetown here in town. And I thought I was going into banking. I had a summer associate with JP in New York, where they paid me stupid amounts of money. And I'm like, that's where I'm going. My family wasn't super excited about moving to New York, but it was a great job. And then they pulled the rug out from under me at the last minute, and I didn't have a job. And I went hat in hand to career services at Georgetown. And they're like, have you thought about working for the government? I was like, no, actually, I haven't ever thought about that. Last time I worked for the government, I was carrying a rifle. And they said, I think you would really like this place called O&B. And I'd never heard of it. And so I began to reach out to people at O&B who were alumni of Georgetown and SAIS. And they were very kind to meet with me. I had coffee with them. I'm like, this is amazing. I love these people. I applied for a job because of my finance background. Before grad school, I was in finance. And I'd worked as summer associate with JP and so I had a finance background. And so I got a finance job at O&B in this quirky place called the Credit Crew, which I'd never heard of, and a place called BRD, which I didn't know what that was.
No one else does.
Still to this day.
And I had a former military background, which I think had something that was helpful in that day and age. I got there and I absolutely loved it. I'm like, these people are amazing. I hear rumors about feds who are disconnected or not paying attention. I don't know, they say that on the news, but these people are really hardworking. So I really loved O&B and I loved working with the people there. I learned a lot from them. And so after working there for a few years, sort of the call of the private sector came back, because I think that's kind of in my DNA. I love the policy, I love the finance, but I wanted to go back to the private sector. And so after a few years, I jumped back to consulting, and a couple of quick detours, but I sort of dedicated my career to helping federal agencies build better banking operations. And I've always believed, because I'm an OMB alum, that when properly engaging with OMB, you build a better program. Like, we don't need to fight OMB. OMB isn't perfect, because neither am I, but they're really trying hard to make better lending programs. And I think that when we're working with them and following their guidelines, because they are a regulator, we're going to make better loan programs. So my background at OMB helped me to understand how to comply, but also make better loan programs. And that was almost 20 years ago.
So let's
believe
start with a really simple question.
Yes, sir.
Why? Why does the government have loan programs in the first place? Many
That
people
is a
got to assume that the financial system is adequate to supply Americans whatever needs they have.
That's a great question, Robert. And I like the policy questions. Just to double down on your question, the United States has the most robust, diverse, innovative financial sector in the world. We export that stuff. We're so good at it, right? Why in the world would we need the government to help people with lending? Like, we do a really good job of that, especially our municipal bond market, which is unparalleled for infrastructure development. And I think the answer is that there are certain superpowers or certain risk tolerances that the U.S. government can bring to bear that the private sector is unable or unwilling to engage in. And that helps policy get done. I also think that this country is politically speaking, compared to our cousins in Europe or other industrialized nations, tends to be a little bit more moderate. Some would even say slightly right-leaning, and we tend to like less intervention in government compared to some of the industrialized nations. And credit is a way to get policy done that's not grant-making or just direct construction. So if in other industrialized democracies, if you want to build a bridge, then the capital decides to build a bridge and they send people to build the bridge. That's not how we do it in this country. Local leaders and local governments decide if they need bridges or water infrastructure or rail lines or broadband. And once they decide that, then the way we help them is we give them a loan and they have to pay it back with interest. And I think in America, we like it better that way. We believe in federalism and local control, and local government tends to govern better than a faraway central government. That's kind of in our DNA as a country for many policymakers. And I think federal credit is a way to help reinforce local decisions. And so for infrastructure, I think it's reinforcing local decisions, but also I think for other things, there are certain risks that the private sector is just unwilling or unable to take, even for credit that's a good credit risk, like high credit quality. They just won't or can't do it. And so that's where the U.S. government can step in. If we are replicating the private sector terms and conditions, we should ask why we have a federal credit program. So I think that's kind of a litmus test for me.
So we've seen over the last couple of decades a pretty strong increase in the use of credit and lending at the federal level. And this is to your point at the beginning about the infrastructure and loans to municipalities, but it's also, there's an individual lending portfolio too at the federal level for student loans, for housing supports. It goes across many, many different agencies. So tell us your view about how that increase in reliance and use of lending as opposed to direct spending. First of all, tell me if I'm wrong, if I am. And second of all, what's your view of what the impact of that, and both how Congress decides to spend resources, but also the oversight role of the executive branch and independent agencies? That talk a little bit about that and that increase and what the impacts have been.
Great question. So I really think the answer, and there's so many things about federal credit which I think have different answers based on the type of program it is. And broadly speaking, in federal credit, there are two parts of the family. There's large number consumer-ish loans to citizens. Think small business loans, mortgages, farm loans, student loans, things like that. That is I would say the traditional view, the longest standing view of federal credit. A lot of times when you go into federal credit circles and people talk about federal credit, they're only thinking about that. But there's this whole other part of the family, which is a little bit newer. It's really come to the fore in the last 20 or 30 years, more or less, which is individual loan by loans for construction, infrastructure, water, nearshoring and manufacturing, think highway loans, stuff like that, right?
Well, now, and even now, there's a new office at DoD that's doing it in a similar way for in the defense industrial complex too. But just building on your point, there's more and more
part
of
that
too.
family. Great point. We're calling that industrial policy. I think 15 years ago, industrial policy was something that we only thought the Europeans did, but we're doing that now. We're using federal credit, I think, to strengthen the economy in certain key industries. And but to answer your question, Adam, I would really think of it as two different ways. I think the latter one is easier to, they're two different answers, but I think the core of both is we have to run good credit programs. We have to treat this like we have to underwrite credit well. We have to expect borrowers to repay. We have to follow good, I would say, banking and lending protocols. And when we don't, the programs find themselves at risk. And when they find themselves at risk, we, as a country and as policymakers, could lose that tool. I think the example around student loans was a very interesting one, because I think that when we almost forgave loans but didn't, that created an enormous amount of problems within the program. And now the program is really struggling as a result. And I don't want to say too much about policy there, but I do think that student loans and the experience that we have with them reminds us that we need to make sure that we're running a loan program like our loan program. And if we want to run a grant program, there are really good guidelines to follow when we run a grant program. So I think that the guidance that we read from OMB, but it's frankly not just OMB guidance, it's other sort of good common sense kind of reforms. When we get away from those, then I think we run into trouble. And one of the things that I just want to point out, what the government has never been good at, that is not our superpower, is to take really bad credit, or what I call crappy credit. Like, we're just not good at that. Other lenders are, but we've never been good at taking crappy credit. We're really good at other things that are popular, or that are needed, but we're not good at that. So we don't really want to run programs where we're making loans to people who can't pay them back. And when we violate that, I worry about the sustainability of the program, because it'll lose political support on the Hill. Critics will be sharp-tongued and accurate. And so those are, I'm not sure if I'm answering your question. I might be bouncing around.
Very helpful.
And I'm going to pull the thread a little bit. You've highlighted a sort of a core challenge facing this whole policy realm, but what other challenges do you see loan programs facing in the federal government? What are their particular challenges?
Well, I think if I can step down below policy, I think there's basic operational challenges. Federal credit programs, some of them are really old. They've been around a long time. And the Congress is not wild about investing in technology modernization. They love to invest in programmatic work, but they don't like to invest in back office-y stuff. And so I'm sure your other guests have highlighted this a lot, but we need to update and modernize our IT infrastructure and portfolio management systems. Some of these systems are just really, really old. But in my view, we talk a lot about that. What I think we should also be talking about is, while we do that, we need to be scrubbing off the barnacles of some of the policies and even regulatory requirements of these loan programs. Some of the quirks that we find in the technology are born by quirks in a reg. For example, I've seen regs that have loss coverage ratios in the reg, where that's the kind of thing you would have in an underwriting handbook or something. But when you put something in a reg, it's like, oh my gosh, that's hard to undo. So I think that we have outdated for those large programs that do citizen lending. This is especially true. We have outdated systems. We've got some reg cleanups to do so that when we fix the system, we're not getting good technology for a bad process. We need to fix the process and the technology at the same time. I think on the loan by loans side, I think that the things that threaten is that programs need to have a clear understanding of what their mission is and what they want to do. The CHIPS program, for example, it knew exactly what it was supposed to do. Semiconductor manufacturing, easy to understand. Highway loans, that's what we do. And I think that as we continue to launch new programs, especially for industrial policy, I think having a clear understanding, what does success look like? What asset classes are we focused on? How does it match with the administration's policy priorities clearly? And so I think for the newer programs, they need to make sure they have a firm view of their mission and their understanding. One other problem is just hiring staff with a strong finance background. I think this is a highly compensated industry, and to get people to leave those highly compensated private sector positions and take a position in government usually means that they may only stay for 3 to 5 years. And so how do we recruit and deploy those people alongside a more permanent federal staff, I think, who are properly trained? So those are some things that I think that I see with my clients as we continue to operate. But I'll tell you this, notwithstanding those challenges, Adam, I think that, or Robert, I think you asked the question, I think federal credit programs are going to have a bigger role to play going forward, not smaller.
Wow.
So that leads me to, I think we have time for one more question, but so, I'm mainly, my background is in fiscal policy and budgeteering, and once a budgeteer, always a budgeteer. So this sort of reminds me a little bit of what it was like before the Budget and Impoundment and Control Act of 1974, when Congress made individual laws on appropriations and authorizations without actually knowing how much total money they were spending every year.
Mm-hmm.
So is there a threat to how much the government is on the hook for if these loans fail, now that we've sort of expanded the use of lending in a variety of ways, which you've described really well? Is anyone keeping track of the total amount that the government is lending out at? I don't see that as part of the budgeting process. And some of the lending programs are sort of off book. We don't need to get into technicalities about how the scoring for lending programs goes as compared to direct appropriations or mandatory spending. But do you feel like that's a worry that you have? Because I feel like you're able to see both specifics in programs, but also that sort of 30,000 foot view of the potential risk that the federal government is opening itself to.
I think it's a worry that we should wake up every single day and re-engage with it. It reminds me when I was in the military, when I was in the Army, I went through a brief stint where I was jumping out of airplanes, and the joke was this job would be great as long as we didn't have to jump out of airplanes, which is like that's the job. That is the job. And so managing credit risk is the job, and we have to do that job well every day. What I will say is that so far we as a community have done a pretty good job. Now, why do I say that? I want to make sure I have evidence. Look at the losses that we suffered during the 2008 financial crisis. We suffered them in federal government. Compared to the private sector, we did much better on a credit loss perspective. That's just one example. I could give others. If you look at all the upward and downward additions we've made to loss reserves in the 35 years of federal credit, we've had to add more to loss reserves, and we've also taken away because we overestimated risk. On balance, that pretty much sums to zero. In other words, we as a community have done a pretty good job. Now, I'll give OMB credit. They're very conservative, and they understand that this whole lending idea will come to an end if we're overwhelmed with credit losses. The Congress won't tolerate it, and they shouldn't tolerate it. The president shouldn't tolerate it. So we have to wake up every single day and guard credit risk closely, which is why we're not well suited to take crappy credit. And we try to avoid that, I think, and for all programs. So I think so far so good. And what I would say is, as a person, as a citizen who loves this country and wants to see it do well, I would ask the way I'm comfortable with that risk, Adam, is I would say, okay, if we want to get bridges built and we want to get hospital rooms funded, emergency rooms in rural America, their only lender is the community facilities program with the RHS. Like that, their banks literally won't lend. And so if we want these projects to happen, if it's not federal credit, then what is it? Because the counterfactuals have risks, downsides, consequences, et cetera, that in that counterfactual world, we'd have to consider what those would be. And I think in the main, we absolutely have to keep a close eye on credit risk. And I'll also say, as a finance guy, our federal credit program as a government 5 trillion is very well diversified. We've got everything in there. And typically credit doesn't all move in the same direction. Mortgages and power plants and semiconductor factories and you name it, they're as diverse as the economy is. And so they're at least not correlated. We have a lot of housing risk, that's for sure. But we went through the worst housing crisis in 100 years in 2008, and we didn't do too badly compared to the private sector. So yes, we absolutely need to guard it every single day. And if we take our eye off the ball, that could go bad, but that is the job. We jump out of planes and we have to take that seriously.
Well, you jump out of planes.
Thanks so much, Anthony, for this tutorial. It was fantastic. It's like more than a 101, almost a PhD on the subject. You're kind to lend your wisdom to us.
Well, thanks for including me, and thank you for doing a lending brief. I love it when people recognize this as a important area, and so kudos to you. I'm glad you've done that.
Thanks so much.
Thanks, Anthony.
All right.